Transition from standard financing to strategic assumption opportunities. We have completed the residential resale real estate purchase contract from offer through remedies and walkthrough. Now we step into addenda you may encounter in today's market. With interest rates significantly higher than they were in prior years, loan assumptions have re-emerged as a strategic tool. In 2020-2022, many Phoenix area buyers locked loans at historically low interest rates. Today, if that loan is assumable, it may create a powerful advantage for a new buyer. The loan assumption addendum modifies the financing structure of the transaction. It replaces new financing with transfer of an existing loan. This requires careful drafting, lender coordination, and client education. This addendum is not simple. It carries risk for both buyer and seller. What is a loan assumption? A loan assumption occurs when a buyer takes over the seller's existing loan, including its interest rate, remaining balance, and payment terms. Not all loans are assumable. Generally, FHA, VA, and some government-backed loans are assumable subject to lender approval. Conventional loans are typically not assumable unless specifically permitted. Gilbert example seller has FHA loan at 2.75% interest from 2021. Current market rates are 6.75%. Buyer assumes FHA loan, preserving lower interest rate. Buyer pays difference between loan balance and purchase price as cash or secondary financing. Assumption becomes a negotiation advantage. Assumption, contingent or non-contingent structure. The addendum requires parties to specify whether the sale is contingent upon buyer qualifying for assumption of the existing loan no later than 3 days prior to QOE. If contingent, buyer must qualify with lender. If not contingent, buyer assumes risk of qualification failure. Precision is critical here. Phoenix example buyer writes offer contingent upon qualifying for assumption. Lender denies buyer qualification. Contract may cancel under financing contingency structure. Without contingency protection, buyer risks breach exposure. Approval of loan terms. Deadline control. The assumption may be contingent upon buyer's approval of the loan terms within a specified number of days after acceptance or receipt of terms. Buyers must review interest rate, fixed or adjustable, remaining loan term, current payment amount, mortgage insurance obligations, impound requirements. Scottsdale example, buyer discovers assumed loan includes adjustable rate provision resetting in 2 years. Buyer disapproves within stated deadline. Review period protects buyer from inheriting unfavorable loan terms. Type of loan, FHA, VA, conventional, other. The addendum requires identification of loan type. FHA loans are commonly assumable with lender approval. VA loans are assumable, but buyer must understand implications of VA entitlement. Conventional loans rarely allow assumption without express lender consent. VA example. Seller with VA loan allows civilian buyer to assume loan. Seller's VA entitlement remains tied to property unless properly substituted. Seller must understand future borrowing limitations. This is why the addendum instructs parties to consult licensed professionals. Current interest rate and payment structure. The addendum identifies whether the rate is fixed or adjustable and the current payment amount. This information directly affects buyer affordability calculations. MESA. Example. Buyer assumes loan with pity payment significantly lower than current market loan would produce. Buyer avoids higher monthly payment and closing costs associated with new loan origination. However, buyer must often pay substantial cash to bridge equity difference. Loan balance and cash down payment adjustment. Loan balance listed is approximate. Any difference is reflected in cash down payment or other agreed adjustment. Example, purchase price, $600,000, existing loan balance, $400,000 buyer must bring $200,000 plus closing costs, unless secondary financing arranged. This is where many buyers underestimate cash requirements. Mortgage insurance and impounds. If assumed loan includes mortgage insurance, buyer assumes that obligation. Impound accounts must be brought current by seller and prorated at COE. Queen Creek example. Seller behind on escrow impounds for property taxes. Seller must bring account current before transfer. Failure to reconcile impounds can disrupt assumption approval. Assumption costs. Who pays? The addendum allows allocation of assumption fees and transfer costs between buyer and seller. Negotiation point in competitive transactions. In high-equity Phoenix properties, sellers may agree to share assumption fee to incentivize buyer. Credit evaluation. Seller protection option. If structured as contingent upon seller's approval of buyer's credit, buyer must provide credit report and loan application within 3 days after acceptance. Seller may disapprove buyer's credit within 3 days after receipt. This is common when seller remains partially liable on loan if assumption is not fully released by lender. Seller example. Seller concerned about buyer's financial stability requests, credit approval contingency. Risk allocation must be clear. Broker limitation of liability. Professional boundaries. The addendum expressly states brokers are not qualified or licensed to advise parties regarding loan assumption risks. Loan assumptions involve tax consequences, liability exposure, and future credit implications. Brokers must instruct parties to consult. Licensed Arizona attorney, tax advisor, mortgage professional. This protects brokers from liability beyond scope of licensure. When should you consider a loan assumption in today's market? High interest rate environment. Large spread between existing rate and current market rates. FHA or VA loan with favorable terms. Buyer with strong cash position. Seller motivated to create competitive advantage. In Phoenix, this strategy is increasingly relevant in 2024-2026 transactions. Why has loan assumption become more common in higher interest rate markets? Answer: because buyers may assume an existing lower interest rate loan, significantly reducing monthly payment compared to new financing at current rates. What is a major risk to sellers in a VA loan assumption? Answer: seller's VA entitlement may remain tied to the property unless properly substituted, limiting future borrowing capacity. Why must brokers avoid giving legal or tax advice regarding loan assumptions? Answer: because assumption carries financial and tax implications beyond the scope of real estate licensure, and the addendum explicitly requires consultation with qualified professionals.